Insurance companies and pension plans are major institutional participants in global financial markets because they collect funds from policyholders and contributors, invest those funds, and provide financial protection against future uncertainties. Insurance companies help individuals and businesses transfer risk by pooling losses across many policyholders. Life insurance companies focus on mortality and longevity risks, while property and casualty insurers cover events such as accidents, natural disasters, and liability claims. Pension plans, meanwhile, are designed to provide retirement income to employees after their working years. These institutions play an essential role in financial stability because they manage large pools of long-term capital and influence investment markets through their asset allocation decisions. Insurance companies face several important risks that require careful management and regulatory oversight. Mortality risk arises when policyholders die earlier than expected, increasing claim payments for life insurers, while longevity risk occurs when individuals live longer than anticipated, increasing pension and annuity obligations. Property and casualty insurers face underwriting risk due to uncertain claims from catastrophes, lawsuits, or accidents. Insurers also encounter market risk because their investment portfolios are exposed to interest rate changes, equity price fluctuations, and credit events. Actuarial science and mortality tables are used extensively to estimate probabilities of claims and determine premium levels that ensure insurers can remain profitable while meeting future obligations to policyholders and beneficiaries. Pension plans are generally categorized into defined benefit plans and defined contribution plans. In a defined benefit plan, employers promise employees a predetermined retirement benefit based on salary history and years of service. The employer bears the investment and longevity risks because it must ensure sufficient assets are available to meet future obligations. In contrast, defined contribution plans specify the contributions made by employers and employees, while the employee bears the investment risk because retirement income depends on portfolio performance. As populations age and life expectancy rises, many organizations have shifted toward defined contribution structures to reduce financial burdens. Pension funds must carefully manage asset-liability matching to ensure long-term sustainability and meet retirement obligations. Insurance companies are also exposed to moral hazard and adverse selection problems. Moral hazard occurs when insured individuals behave more recklessly because they know losses are covered by insurance. For example, a driver with comprehensive auto insurance may take fewer precautions against accidents. Adverse selection arises when insurers cannot distinguish between high-risk and low-risk applicants, potentially attracting riskier customers disproportionately. Insurers address these challenges through underwriting standards, deductibles, policy limits, co-insurance arrangements, and ongoing monitoring of policyholders. Effective risk classification and pricing are essential for maintaining profitability and solvency. The program highlights that managing these behavioral and informational risks is just as important as managing financial risks in insurance operations. Regulatory capital requirements for insurance companies differ significantly from those for banks because the nature of insurance liabilities and risks is distinct. Under frameworks such as Solvency II, insurers are required to maintain sufficient capital above both the minimum capital requirement, MCR, and the solvency capital requirement, SCR. If capital falls below the SCR, corrective measures are required, while falling below the MCR may lead to severe operational restrictions. Property and casualty insurers typically require more capital than life insurers because claim patterns are more unpredictable. Unlike banks, which rely on permanent deposit insurance funds such as the FDIC, insurance guarantee systems generally depend on contributions from insurers after a company becomes insolvent.